Much to my, and I'm sure many other people's surprise, Dollar General, which has had a very rough few years, seems to be starting to turn things around, which is something that I did not expect at all. The Morning Brew starts us off today. Dollar General raises outlook amid economic uncertainty, the stores that do well when everyone's nervous. And this is important to remember because there are industries, or at least products within industries, that do better when the economy is bad or people might think it will get bad. These products are called inferior goods by economists, and it doesn't mean that the products are actually bad. It just means that they do better when people are doing poorly. Think of something like Little Caesars pizza. It does better when the economy is bad because it's so cheap. If you don't have much money or think you might soon not have much money in the form of a layoff, then when you want pizza, it makes sense that you would go for the cheaper Little Caesars as opposed to the more expensive Domino's, Papa John's, or some wood fire oven pizza. The article continues. Canada Dry is no longer the biggest winner during turbulence. Dollar General reported better than expected Q1 earnings yesterday and raised their full year estimates, not in spite of tariff price hikes, but because of them. The budget retailer credits economic uncertainty with pushing higher income shoppers into its discounted aisles. And this is not something that I had predicted. You may remember that a few months ago I put out this video called Dollar Stores Are Dying, in which I basically said that higher income people purchase from stores like Target, Kroger, and Walmart, and lower income people purchase from stores like Dollar Tree, Dollar General, and just other dollar stores. And that means that when prices go up, those low income people no longer have a place to shop because it doesn't really get cheaper than dollar stores. So they just stop spending money. And that's one of the reasons why dollar stores were struggling so much, is because inflation hit, and so prices went up, and low-income people, instead of purchasing different or cheaper goods, of which there were none because that dollar stores were as cheap and different as it got, they just stopped spending money, and so dollar stores saw their profits go down because of that. Now, there were a lot of other issues, but at a large kind of high level, this was one of the big causes of people no longer shopping at dollar stores. But it turned out that that prediction I had was really only partially correct, and we'll get to more of that in just a second, but moving on to the other paragraphs of the article. Dollar General said its sales jumped 5% last quarter, rising from $9.9 billion during the previous quarter to $10.44 billion. While customer traffic dropped slightly, 0.3% compared to the previous 3 quarters, the average amount spent per transaction went up 2.7%. And this is where the partially correct me was. The customer traffic dropped slightly, 0.3%. This is that low-income customer that is no longer able to purchase anything at all because there are no cheaper goods that they can go for. They simply have to purchase less because their money has not kept up with inflation. But this is the part that I was wrong about. The company said that it's added more seasonal decor and home items, which attracts wealthier people who would like to respond to compliments with, "Would you believe it's from the dollar store?" What I got wrong is that I thought high-income people would stick to places like Walmart, Target, Kroger, etc., and not move down to dollar stores when things started to get tight. But it's turned out that higher-income people are actually coming down to these lower-cost stores like Dollar General. And essentially, everyone has kind of moved down a tier. If you shop at like Whole Foods or Erewhon or places like that are really expensive, then you probably bumped down to places like Kroger, Target, and Walmart. But if you shopped at Kroger, Target, and Walmart, then you've bumped down to places like Dollar General. And if you shop at Dollar General and you haven't really had anywhere to go, and that's that 0.3% again of foot traffic going down. But this caught me off guard. I had not suspected that people of higher incomes would move down to Dollar General. I just thought they would take the hit on their wallet. But it turns out this is what they're doing, and this is where higher income people are going, to dollar stores. Companies like Costco and Walmart have shown similar success during economically bumpy times as higher income customers tighten their belts. Chris Nicholas, CEO of bulk buyer Sam's Club's US, told Financial Times, "Through good times we do well, and through times that are tough we do even better." The retailer, which is owned by Walmart, reported a 6.7% increase in sales last quarter. Costco, meanwhile, reported a 7.9% increase in sales last quarter. Don't forget the soup. Campbell's Company said that customers are cooking at home at levels that it hasn't seen since the pandemic. Sales of broth were up 15% last quarter. While Big Bone and the publishers of chipped beef cookbooks might be celebrating the news, those numbers aren't a great sign for the economy overall. And so here we have another group of people that are tightening their budgets. The people that are eating out, or at least they were eating out, but now they're deciding to eat in because the economic uncertainty of whatever situation they're in. Now, obviously eating out is way more expensive than eating in, but when you do eat in more, what you have to do is you have to purchase more groceries. And where do you think people are purchasing these groceries from? That's right, places like Walmart, Sam's Club, and the Dollar General stores. And this is all really fascinating to see. Higher income people are moving down a tier to lower cost, smaller budget stores, and And at the same time, they're choosing to eat in more instead of eating out, which requires them to purchase proportionally more groceries, even though it brings their overall food bill down. And grocery stores, specifically ones targeting cheaper goods, are benefiting from this. Now, before we move on and talk more about this, if you like this kind of video, I post 1 or 2 times a week, and I'd love a subscription. So to reiterate, there are 2 categories of people that spent money other places that are now choosing to take the money they spent in other places and bringing it over to low-cost grocery stores. Those people are, first, people that shopped at more expensive places. And second, it's people that ate out a lot and didn't cook at home as much. Both these categories of people are seeing things like tariffs, layoffs, economic uncertainty, and are stockpiling money. And to stockpile money, they have to cut costs places. And a really easy place to cut costs is grocery stores, because you go to somewhere cheaper, or you purchase the private label, like great value brands instead of the name brand things, or you stop eating out as much because that costs a lot of money, and that's a really good way to save money. And this has caused Dollar General's stock price to absolutely skyrocket. As of Tuesday's close, shares of Dollar General have risen 48% so far this year. That far outseeds the roughly 1% gains of the S&P 500 during the same period. Shares of the retailer closed at $112.57 on Tuesday, bringing Dollar General's market valuation to $24.76 billion. Dollar General's first quarter earning results and its stock performance stand out in a retail industry that's already taking a hit from President Donald Trump's tariffs. Companies including Best Buy, Macy's, Abercrombie, and Fitch have cut their profit outlooks during the tariffs. And Dollar General is uniquely positioned to take advantage of the opportunity that tariffs have caused because everyone needs groceries. Everyone has to eat. But other companies that sell stuff that people want but don't necessarily need to survive are taking a hit. Some of them listed here are like Best Buy's, Macy's, Abercrombie, and Fitch. They sell electronics or clothes. And those are both things that you can probably do without, at least for a little while, if you're trying to really tighten your budget. Probably the clothes you own work just fine, or the TVs you have you can continue to use, or the new gaming console you want you can get later if the economy improves. You can imagine that people suspect if the economy might get bad, it's easy to forego those things just for a few months just to make sure that everything's going to be okay. Now, every time a company has news, whether it's news that things are going really well, like Dollar General, or news that things are going really badly, like Best Buy, there's always 2 reasons given for that. One is the real reason, the reason the thing actually happened, and the second is the reason that the CEO gives to try and either make it look like they're doing their job really well, or that if it was bad news, it wasn't their fault. And here is the reason that the CEO gave for Dollar General doing well. On an earnings call Tuesday, Dollar General CEO Todd Vasos said that the company has worked to reduce its exposure to China and limit price hikes for shoppers. He said that the retailer has worked hard with vendors to cut costs, moved manufacturing to other countries, and made changes to its products or swapped them out for other merchandise. He said that direct imports make up a mid to high single-digit percentage of its overall purchases, and indirect imports are about double that. While the tariff landscape remains dynamic and uncertain, we expect tariffs to result in some price increases as a last resort, though. We intend to work to minimize them as much as possible. Now, I kind of sort of a little bit believe this, but mostly I think it's just a PR statement. A lot of the things that he listed aren't necessarily new. He talked about working with vendors to find ways to cut costs and not wanting to raise prices except as absolute last resort. But all of those things are stuff that the company would have been doing anyway. There's no way a company that's for profit and publicly traded, like Dollar General is, would just choose to pay higher prices to their vendors. Every company ever that has vendors or manufacturers they have to work with is constantly working to try and get the lower price to make the larger profit margin. What he's saying that they're doing now that's working really well is stuff that the company's been doing for years in which they did poorly for a long time, and now it's probably going to be doing those same things in years in which the company's doing really well. Now, I'm not by any means saying he's a bad CEO. Dollar General was doing quite poorly in 2023 when he was put into the role, and now the company is doing much better. It's hard to deny that. But I also do want to make it clear that a lot of the good things that are happening to him and the company just kind of fell into his lap, and he is very quick to take credit for them. Additionally, I thought it was really interesting that he made a big deal about moving things out of China. He says here that the company has worked to reduce its exposure to China. And I think this is probably a play for him to try and get good PR towards people that don't want America to be reliant on Chinese manufacturing. That's kind of a big thing that the Trump administration is pushing, is that America should be reliant on itself, or at very least not so reliant on China as we are now. And I think the CEO of Dollar General, Todd Vasos, saw this as a great opportunity to hype up the fact that they're moving away from dependence on China, hoping to build some of that patriotic goodwill towards the company, saying, hey, look, the thing that is popular right now that our presidential administration is trying to accomplish, we are doing that. So come shop at Dollar General and make us more money. And honestly, purely from a business perspective with no political involvement, that's not a bad plan. If you're an American company, you want your American consumers to like your decisions. And if currently the popular decision is to move away from a reliance on China for manufacturing, then it makes sense that you position yourself in that way to try and get those patriotic customers. But it's important to note that this is almost exclusively marketing and PR. How much of this is actually true is always kind of up in the air with these kind of things. So if Dollar General is doing well, but the reasons that they're doing well are not necessarily the fault of the CEO, the question becomes, well, is this sustainable then? Will things go bad for them again once the economy improves, or if we have a Democrat elected in next election cycle? And I actually think things could improve permanently for Dollar General. I don't think this is temporary like it is with a lot of other companies. See, if Dollar General can make enough money here to figure out their supply chains to reduce either reliance on China specifically, or develop relations in other countries like India or Vietnam, or maybe even build manufacturing plants to create the products they need here in the United States, then that could be exactly what they need to get out of the rut that they've been in the past few years. So I would label myself as cautiously optimistic for the future of Dollar General. I obviously wish them all the best. I like to see people in American companies succeed, but we will have to wait and see what happens, but who knows? This could be the turnaround for Dollar General. Thanks for watching.